Good morning, everyone.
Good morning, sir.
Okay, good morning. Okay, basically, last week we were discussing about how we can simulate using historical simulation model and variance covariance model. Okay, right? So that's what we did last time, where you have given a set of data, historical data, and you can use it for look at your portfolio risk for any future period at a given confidence level. So basically, the VAR is based on two fundamental variables. So what are the two fundamental variables? You interpret VAR, two things. In interpreting VAR, you look at two things. What are the two things you look at? Suresha? Two things, when we interpret VAR, we are talking about two things. So what are the two things we look at? Can anyone tell? What are the two fundamental things? Last week we discussed. Anyone? So when we say the value at risk of this particular portfolio is this much, so we interpret it in terms of two things. What are the two things? We talk about a confidence level and we talk about a period. So when we say over the next 10-day period, the value at risk at 95% confidence level is this much. So that is the maximum possible loss, right? So that's how we interpret value at risk, isn't it? So similarly, you can talk about 10 days, 30 days, 100 days, any period you think of in your future. So that is the two variable, two parameters when we discuss value at risk model, right? So the historical simulation is pretty simple. I think all of you could be able to answer any question if you get by chance in the exam about historical simulation and also value at risk simulation given a set of data. Okay, so we looked at the model for individual or single investment and also for a portfolio investment, right? So you can do it for anything, single investment value at risk or portfolio investment value at risk. Okay. Any more questions from that area? Today we move on to the third type of simulation, the Monte Carlo simulation, right? Are there any questions? Hopefully everybody should be thorough. Okay. Okay. So we in the class, I don't see many in the class now. When we started this class, we had so many, but now gradually, I don't know whether they have moved away from the course or they are not participating. So see a gradual reduction. So please ensure you participate because there is no guarantee you pass the exam. It's an easy way of doing things because if you don't participate, don't ask questions or clarify things, you will be having problems because especially in an online class, right? So participate daily basis, clarify things if you need anything, and so you have to ensure your questions are sorted out. Okay, sorry for little disturbance. So we'll move on to a Monte Carlo simulation exercise. So I think all of you can see this Excel sheet. Can you see this Excel sheet? Can you all see this?
Yes, sir.
Okay, so please respond, kindly respond if you can see this. If you can see this, please say yes or no. Okay, so I know I can move. Okay, now open your Excel sheets in your laptops. Open your Excel sheets in your laptops. And here in the A2 and A3 and B2 and B3, I have given some information, very simple information about stock index return and a stock index standard deviation, right? Here I have selected S&P. S&P is a index, stocks traded in New York. So like our ASPI, and here is standard deviation of S&P. Average of daily returns. So these are S&P average, in, okay. So put that average and standard deviation of daily returns over the past 50 years. So it's a huge data set. So don't worry about this data. You have been given average and standard deviation over a past 50-year period, mean and standard deviation of returns. Did you copy that?
Yes, sir.
Okay, thank you. Okay. So basically, we have only two numbers now. So what are the two numbers we have? Now think about like this way. Okay, this is in Sri Lankan Stock Exchange, there's an all share price index. So assume this is all share price index. Okay, these are actual data. Remember, this is actual data. So it's like all share price index over daily returns over past 50 years. Now here, because now in Sri Lanka Stock Exchange, you can't get 50 years. Similar to that, like assume ASPI daily returns over the past 50 years. So this is standard deviation, volatility. Now we are going to run a simulation. Now I have created B7 to B9, create day 1, day 2, day 3, day 4, day 5. Right? Now you have to work with me because otherwise if you miss, you will not get a somewhat comfortable simulation return. Okay, now we are going to now run a simulation for that. Now let's say you want to find out if I invest in this index, if I invest in this particular index, because some companies invest in indexes. Even here in Sri Lanka, some especially unit trust and all, they look for an index and index they invest. They create a portfolio based on index. Okay. So now we want to simulate through the computer to generate a random number. for the next day return. So there may be 1,000 of random numbers that simulation can derive you. So if you have 20 with us today, you will get totally different. So don't get upset if you see my number is different to your number, right? Clear? Okay. Now how do we run the simulation? Okay, day one, I will show you. Okay. Can you see this Excel sheet? Can you see?
Yes, sir.
Okay, now go to immediately C7. If you have your day one, here C7 and generate a random number using this formula. Okay, can you see the formula? Formula part of one is that someone is only responding. Who is that? Eurasia or who is that? Can you all see this? If you see, can please tell me?
Yes, sir.
Okay. So now generate this number using this formula. So this is a simulation. We are doing now simulation. Now here, always remember you refer to the $B, $2 means refer to these numbers. Ensure your brackets are properly done. Otherwise, you will not get a right answer. So please do it. Once you finish, tell me. Everybody has to work parallelly. Don't just skip. By chance, if you get an exam practical question like this, probably with some assistance of your probably laptop, you will be in trouble. Practice this at least one time today. Okay, sorry that problem with IBSL network. Have you come across a number? Everybody got a number here, A1 return, using this simulation formula?
Yes, sir.
Okay, so what did you get? Who is that? What did you get here?
-07983.
Okay, what about others? Anyone else?
So I think you didn't hear about Miss Uresha asked question from you.
Sorry?
Uresha asked question from you. Uresha Valpitali.
Thanks, Dirisha. Sir, I just wanted to check whether we have to type the random and then the brackets when starting the formula. So I'm
You
not.
have to type exactly as it is. Otherwise,
Right.
you will. Okay, you type exactly as it is.
So norm into invention norm.inv, we can get it from the formula, no? So there it asks for the probability. Then we have to type random within brackets, no, sir?
Yeah. I mean, whatever you do, now I have given this formula, no? So use that formula, right?
Yes, sir. So my answer was different from your one. That's why I wanted to check from you.
Exactly. You will not get. That's what I told you. You will not get now. Now see, the earlier answer is not I have got now.
Yes, sir. Got it.
So the previous number is not this number. Now when I click it here, it always changes. So that's why I call simulation.
Yes.
You see. So if you have 1,000 of students in this particular class, you will get 1,000 answers. But remember, at the end, when we look at these numbers are fairly close. right? So that is important. Now this day one return may be quite different. But only thing is, you have to use the right formula. It is not, you know, the wrong sum up, completely outlier answer. There can be outliers as well. So remember that. Huh? So everybody got. I have to do. If I move, then if you didn't get anything, you will, you know, you can't follow up. What about others? Only two. Anyone wants some more time without an answer? Please tell me. Otherwise, I'll move. If you don't say anything that you need time or anything, I'll move. I assume you have. Everybody has got. So done. Okay. Because we are only doing two questions on simulation. One is on using a stock index portfolio return. Other one is the investment return. So if you get an exam question with the laptops, definitely you should be able to work in your own within a limited time frame. Right? The last time simulation question, no one answered. Remember? No one had answered the simulation question. So by chance, if you get two questions, simulation, you will lose. One is historical, one is Monte Carlo, then you are in trouble. Okay. Even very simple historical, you know, simulation one, no one answered, right? Okay. So I assume everybody has done. Comfortable? Okay. Now, what we have to do is copy this one to the rest of the 5 days. Now I am going to look at weekly return or 5-day return. So now you got a number here. So now you copy this to rest of the 4 days and get your returns. Okay, copy this one to these 4 days and derive number. You may not these numbers. Huh? So derive day 2, day 3, day 4, day 5. Can you all do this, please?
Done, sir. The thing is, sir, when we are dragging, again the day one number is totally different.
Don't worry, don't worry.
Okay, sir.
Don't worry. That happened. That is because the computer generates a random number. Don't worry. That's what happened to me, you know. So when you say something, I just click somewhere, this automatically. So don't worry about that. Finally, we will get, you know, some number. But only thing is you copy. So you are, let's say if when I copy, this is 90, it may end up with 75 or something, maybe negative. So don't worry about that. You have to ensure you copy rightly and get some numbers. Next day when you open and start, you know, because the computer has a ghost inside. Ghost will change you. Don't worry about it. That's how this simulation works. Who is that? I can't see any. Who is that, please?
I'm Lanka, sir.
Who? Anuhas.
No, Lanka.
Okay, Lanka. Okay, Lanka. That is the simulation works. That's how simulation works, because it automatically generates a number, hypothetical number. The beauty of simulation is, because now we can't manually do this now, Lanka. Now when we do it through the computer modeling, it will generate thousands of possible scenarios, possibilities. Remember, risk is, now remember when we started the risk, we talked about possibilities, no? Probabilities and possibilities. So it generates, okay, I think this return over the next 1 day, so it could be, you know, we never can predict. So when we run number of simulation like this, at the end of the day, when you average it, you get a comfortable number. So that is the advantage of running 1,000, because you can ask the computer to run many trials as possible, as per your wish. And also, if you look at the historical, now I said this date, these two numbers are 50-year data, actual data. These are not hypothetical data. Okay. Actual returns, right? Actual returns. These are not hypothetical. Because I couldn't get the ASPI data properly, only I took these data. Otherwise, if you can look at past 10-year or 20-year ASPI data, same thing you can do. For your interest also, if you can get data, you can do it, because I got this data easily. So that's why I put this S&P. So these are actual data, not raw. So these numbers are daily 50-year returns, actual. So based on that, you run a simulation. Okay. So everybody got day 2, day 3, day 4, day 5, please. Simply copying you. First day, first one you run with the simulation formula and then get rest of the 4-day returns copy. Lanka, did you get that one?
Sir.
Day 3, day 4, day 5, you got some numbers?
Sir.
Okay. What about others? Anyone else got? You don't remember, you don't get these data, quite different. If you are in a physically in a class, probably if you look at your next somebody sitting next to you, you will see a different set of information. Anyone still doing that, please? No? Okay, I assume no, everybody has done. So now please copy this cell to this one. In my case, D7, whatever you have in your scale sheet, I don't know how did you put these first numbers. So in my case, I copy the same number to D7. So you can also do that. Okay. Okay. Now calculate the return. Okay. Return for day 2 using simple formula. So return, D7 plus 1 into C8 plus 1 minus 1, right? Okay. So then copy this formula to rest of the 3 days. Day 9, day 10, day 11, right? Copy that, right? Okay, so everybody got day 3, day 4, day 5 returns?
Yes, sir.
Yes or no? Got it? Got or no? With the rest of them, now we have to, from this point onward, you have to follow me, otherwise you will end up with nowhere. Because we run the simulation now. You got these numbers in whatever numbers for in your case, for all 5 days return. 1, 2, 3, 4, 5.
Yes, sir.
Okay, everybody. Okay, so silence means I assume everybody got that. Okay, now copy this day 5 return to whatever cell here. Now I have copied it to C13. Okay, copy the day 5 return, that is weekly return, for the, now in my case C13, whatever you, wherever you feel based on your sheet, to a cell like this. So in my case C13, I copied to C13. Now thereafter I want to run a simulation. Now I want to run 1000 trials. So I create on, let's say B14 onwards, B14, 15, I create 1000 trials now. Yes, if you look, see, I have run 1000 trials data. Yeah. Right. More than 1000, I think. More than 1000. So it's 2190 trials. I have run 2190 trials. You can do whatever, you know, anything, but here I have run 2100. So you can also run 2190 trials. 1 to 2190. Create a sheet. Column B from 1, if you go parallelly with me, it's better. You can run the same number of trials. Create a number in the column starting from B1, B14 up to B2203, I think. B2203, generate this serial number 1 to 2190. You are doing parallel with me. I mean, you can run any number of simulations, but let's create this one. So create the sheet now. 1 to 2190. So create 2190 data points. To finish, tell me. You created a number series. Anyone completed?
Yes, sir.
Okay. Everybody completed? Okay. Anyone not yet generate a number series 1 to 2 to whatever number? 2190? No? Okay. Everybody done. Good. So now we are going to run a simulation. Okay. Now here you have your data, right? Remember your fifth day return is copied here. Now select these two cells up to this point. Okay, select B and C up to that point from starting 13 row. Here you have the 15th day return. Whichever the return you got here is here. Now select B and C starting from row 13 up to the end point. Everybody selected? You don't have any data here. You don't have any data here. Now we are going to generate only this. You have this data equal to this one, but these cells are empty. Only this data C13 is here with you. The C13 is the D11, right? Here cells are empty. Right? Okay, everybody selected that? Now do it with me myself, because otherwise if you lose, no chance of doing it again. Huh? So that's why if you have anything, please stop me and ask questions. If you need time, I'll give you. Otherwise, if you just keep cut, I'll assume you are it with me. So don't come and tell after the exam we couldn't do this, that, right? So probably there may be I will see whether we can have laptops in place to generate some, while using simulation. If you get a question like this, so you should be able to do anything historical, ovariance VAR, and Monte Carlo simulation. Okay. Everybody selected these cells, 2 columns. Can we move? Nanka, did you select? I can
Yes.
see. Okay. What about others?
Yes, sir.
Okay. Okay. Good. Everybody, anyone else need time? No. Okay. So now you have only this data here. All of you have this C13 here. C13 data point here. My one is empty because I didn't do these things.
Yes, sir.
C13. C13 is basically whatever you got for D11, right? If they return. Now go to the data. So you have selected. Now go to the data. Okay, data. Then go to what if analysis. You go to data, you will see in the bar what if analysis. Okay, go to data table. Okay. Okay. And output column, so you have this input. So you go to the table. You have this input here. You go to the column. Okay. select any column here and say OK. Right? So you will get some numbers. Go to data, what if analysis, data table, select any cell here, say OK. You will get some numbers here.
Can you please do it again, sir?
So you go to, you have selected the columns, go to data, go to data, go to what if analysis, go to data table. This is the range you have selected. Okay. And you can select any cell here for the output. Let's say I have just put here and say OK. Then you will get a random generated numbers, returns. So for example, I have got these returns. So these are the returns I got. We will get 2,190 returns. So you will get 2,190 returns. You may not get the same number, but something like this. Everybody got your numbers?
Yes, sir.
Okay, you got. Okay. Okay. Now you have generated a simulated weekly return because we use 5-day return. So at the end of a week, you have run how many trials? How many trials you have run?
1,190.
2,190 returns. So these are the simulation gave us 2,190 possible returns, right? So each one say this is one possibility. This is one possibility. This is one possibility. These are all possible returns at the end of the 5th day, weekly return. This is one possibility. So that's, you can run, the beauty is you can run 10,000 trials, 50,000 trials. Any number of trials you can run and create a series. Now here I have put 2000, I don't know how I got 2190. I just ran 2001. You can make it 2000, 3000 or you stop at 2000. So the beauty is when you run many trials, it averages even outliers. So that's why I took 50-year data. Now, when you take 50-year data here, the beauty is within that 50-year, there may be many bumps, very weak situations, booms, busts, everything covered. So that will negate any outlier factors as well. If you look at just now, for example, if somebody doing analysis for a forecasting in 2022, let's say March, if we look at 2020 and 2021 data, definitely there will be problem because 2021, 2020 and 21 all affected by the COVID. So whatever the data will not give a right picture. So when you take a long period, so that's why this S&P actual data for 50 years daily return, actual 50 years daily return. Okay, so let's say 50 years means how many days per year? How many days?
365.
Yeah, but that is normal. But if you look at trading days, around 252. Okay, so around 2. So 15 to 252 points, right? So 15 to 252. So it's more than 10,000. So this gives a fairly comfortable number. So likewise, when you generate simulated numbers also, many times it will give a fairly comfortable. It is better if you can do 100,000. It is better if you can do 1 million. Because this is not something we do manually. So simply you create a data sheet, not as many. Okay. Any questions so far? Are you comfortable with running a simulation? Okay. Now you can compute simple things like average, standard deviation, like what we do in a normal case. Now you can compute using this data scenario. You compute average of C40 into C2203, that is the generated series. You can compute standard deviation using the simple Excel formula, and then you can calculate the value at risk. So any investment you are having, when you know the volatility, now here we looked at the weekly volatility, you can convert into the whatever volatility. Now let's see if you are focusing on weekly, so the weekly volatility is this much. Okay. Then if you have 1 million investment, what could be the value at risk at a given confidence level? So you can compute depending on 95%, 90%, 99%, whatever confidence level, because you know these numbers. So the idea is to arrive at these numbers. Even you can compute the probabilities. Probability of return more than 5% and so on. So you can work with these numbers, anything. You can do anything with these numbers and this series. Okay. So compute average and standard deviation. Got it? Okay. So now you can interpret, depending on, let's say you have invest 100 million, you know the standard deviation of the portfolio. So you can interpret what is the maximum loss within a week over whatever confidence level, 99%, 95%. You know how to do it. We did some questions like Microsoft example, A&T example. But the model you is the historical simulation. Okay. Any more questions on that? Okay, tell me. Okay, let's have a look now. Okay, tell me. I think all of you got the number here. What did you got? Lanka, what did you get? I'll ask all of you so we can have some numbers here.
For the average, I got 1.073885.
Sorry, point
1.073885.
1.07
7 3885.
3885. Okay, we'll go to the next one. 0385, no?
885, sir.
Okay, so let's go to the other one. We'll ask next one. We'll ask about who are there? Can I see the others? We'll ask Amila. What did you get? Can you hear from Amila? But I can see in the screen, but don't know if Amila is there or not. Anjali, what did you get? Okay, can you tell what did you get? We can put it here.
For average, minus 0.05756.
0.05
756.
756. Right. Okay, we'll ask the next one. We'll ask Binali or I don't know, Binali or who was that? Can you hear from? Binali?
0.
Yeah, 0.175
.175 75 0
0
67 670.
Okay, we'll move to the next one. We'll ask Dilshan. What is the number you got? Can you hear from Dilshan, please? No, Dilshan is in the class or gone somewhere else. Can you hear from Dilshan, please? Amila, Dilshan missing. Okay, we'll go to Dulanjali. Can you hear from you, please? Okay, Dulanjali is suddenly missing now. Fatima?
Sir, I got 0.00
Yeah.
00
0.00
9263.
9263.
Yes.
Right. We got this one. Okay, let's move to the other one. Who is next? Kanchana or Kanchana? I don't know. Anatunga? No, Kanchana or Kanchana. Can we hear from you? Kanchana or Kanchana? I don't know. Missing? Okay. So I think some of you are missing here, even though I can see. Kasturi, can you hear from Kasturi?
My one is 0.033.
Okay, give me a minute.
0.033
0.033
405.
405. Okay, Kasturi. Right. Then go to who's the next? Ramesh. Ramesh, can you get here from you? What is the number you got?
Sir, I got 0.146621.
0.146621.
146621. Yeah.
146621. Right. You got this number. Okay, we'll move to the next one. What is that? Sadhana. Yes, Sadhana. Can you hear from me? Sadhana is missing. Sumutu.
It's 0.28.
0.28.
6
6
832.
63832.
832.
Okay. Right. You got some number. Okay, we'll go to the next one. So we can see how the Sumutu is that Lanka you mentioned earlier. Eurasia.
So my average value is 0.111347.
Point
311,347.
347. Okay. Okay, others are missing. Only 17 now. Even earlier one dropped. But okay. Anyway, you have to work yourself because it's not something I will do it again because we don't have time to do many questions. But this is the one very simple question. Given a given stock index, average and standard deviation. So you can do for anything. Stock index. I think that somebody joined just now. I don't know whether she has done Manori. Okay. So you have to work yourself, But now remember, I think some of you got all different answers. But remember, if you run many trials as possible, the deviation would be very minimal. Right? If you look at you run now, if I ask Lanka, I think we were set first, maybe Lanka. So standard deviation, it is different. Okay. Mean return different, but standard deviation also different. So if you look at standard deviation, okay, let me ask standard deviation also. First one, I think, who is first one? Lanka? Or
Yes, sir.
yeah, what is the standard deviation?
It is 3.829517.
3.82. Okay, 82.
9517.
9517. Who got this second one? Whoever who got this one, if you could tell me the standard deviation, please.
Yes, sir. I got 5.0915.
5.0915.
Yes.
What about this one?
5.80 60
Okay, 60 enough. Okay, tell me this one.
Sir, I got 1.638.
638. Okay. Then what about this one?
4.67.
4.67. So you can, so you will see you have different mean, but to run a distribution function, you will get a similar result for the value vectors. Because if you look at if you go for a distribution function, you will get a much more similar result. Okay. Now, can we see now this one? And provided you got correctly. Now let me see how can I run. This is probability. So you can run what you call normal distribution code. I am not going to do it here, and see what could be the different possible statistics you will get under each scenario, but they are more or less similar. I mean, because if you look at this mean and this standard deviation is different. So what usually happens is, in a from a business perspective, when you run different trials, you get all these averages and get a comfortable number. Now these are different averages, so you will get a comfortable number when you average all these also. See, so these are possible scenarios, and you can average these and get a fairly comfortable number and fairly comfortable number for standard deviation. So that could be the one which may probably use for the computation of value at risk, because these are possible scenarios. Or if you run many more trials instead of now 2,190, again pretty small, to run 100,000 trials, probably you will get all of you will get much similar answer. All these numbers would look much similar, closer, because you run many trials as well. So usually at least 100,000 trials you run, you will get a somewhat closer. So it will average all these outlier scenarios as well. Sometimes we can even, now if there are outlier scenarios, we can also drop them under the model when you take the averages. Now if you see suddenly, now let's say unexpected, now say return of 55 point something, and it is you never expect, and so with statistical tables you can do a lot more analysis, which I am not going to discuss, but idea is to show how similar. Now here this could be outlier, 26.6, this could be outlier, so we can take that out. See? So there may be, because this is a random number, no, here this is 31. This could be outlier. So likewise, when you look at outliers, you can take them outliers as well if you want to do the final analysis, right? Okay, I think those who have worked will understand exactly how you do it. So it's simple. You create, now here I run for the 5 days. You can do it for any day, daily, weekly, monthly, whatever. So use the actual data, okay. Create the first number, random number, using this formula, okay. Then copy it down to whatever the period you want, and then calculate the returns, and then take that and run whatever the number of simulation times you want using data. What if analysis, data table, you have selected the cells and create anything here, and okay, then you will get this data. And from this data, you can calculate whatever the statistics you want for the purpose of value at risk. You can calculate averages, standard deviation, probabilities, anything you could do. Okay. Okay. Any questions? No. Okay. So we'll move on to the second exercise today. Now this is about the investment return volatility. Okay. Now you are going to invest currently. Let's say this is a typical exercise for a long-term fund. For example, your superannuation fund. Okay. Or maybe somebody who wants to invest. Now you're developing a product. Somebody develop a product and you are going to invest your long-term funds. Now for insurance company, maybe your superannuation fund in your bank. So your current investment is 100,000. Okay. So based on historical returns, such investments generate about 11.2%, standard deviation 18, and let's say here's the time to retire. Now it's a retirement benefit or something like that. Let's say 30 years. Okay. So you invest in a portfolio. Okay. So annual investment, in addition, you put 10,000 annually for your investment, this particular investment. Now, idea is to run a simulation for possible return or the value after 30 years. Okay, after 30 years. Okay. After 30 years. Let's say a company invests in a portfolio in order for give somebody some amount at the end of 30 years under the investment plan. Okay. So these are the parameters. Current investment is 100,000. Annual investment is 10,000. Average return is 11.82. Standard deviation of return is 18. Time to retire means now here I have put retire, but time of maturity is 30 years. Okay. So you want to say after that. This is very good for long-term investment funds. When you invest for long-term. So take these numbers down in your Excel sheet. These numbers I have shown here for the purpose of exercise. Okay, you got it down?
Yes, sir.
Okay. Okay. Okay, now we will create a random series. Okay. Before that, okay. Now we want to create a random series. okay, and run a simulation. And now whatever column you copy, up to 30 years, up to 30 years in a column. Now I have put it in a column. Create a series for 30 years. Create a series for 30 years. I have given here. And generate a number for returns. Like what we did last time. So I have put in the G10. Okay. Generate a number for return using this formula. Year 1 return. So because we want to find out, now last time daily return and weekly return, now we want to find out after 30 years, what are the possible returns I would end up if I invest in a portfolio like this after 30 years. Especially when you develop product for the customers, then you have to invest those in an appropriate investment. On the other hand, everybody got a number for this year 1 return, random number. Got it? You get first number. First year return. Okay, anyone got a number for first year return?
Minus 0.0992.
Okay, okay. So all of you got numbers. Now do the same thing like what we did for the last question. Now copy this return for the rest of the 30 years. Right? So now our time horizon is 30 years. Copy this to the rest of the cells. Copied and generated 30 random returns. Okay. Okay. Now we want to calculate. Now these are the return, but we want to look at our value. So first year value is you started with 100,000 plus you got a return of this much. Okay. Plus at the end of the year you invest 10,000. So your ending value, because this is a negative return, will be this much. So your ending value is, for me, as per these numbers, 102,346.6. So compute the ending value using the return. Everybody got this first year ending value? No? Everybody got? Anyone got ending value? Anyone got ending value? Not yet. Can we ask someone?
So 131,811.86.
Okay, you got
31,811.86.
131,000 or whatever number. Okay. What about others? Okay. Now then compute the second year ending value, because second year ending value is this one plus this return, this return plus annual investment. So that is the second year return. So compute second year return. You computed first year return. Now compute the second year return. Can you compute second year return? Then from second year onward, you can compute up to 30 years. It's in the same formula. From here onwards, you can use the same formula. You see? So first year, second year, then use the same formula to compute the, sorry, not the return, N value. N value. So once you finish ending values up to 30 years, please tell me, so we can move to the simulation. Finish? Duration?
Yes, sir.
Okay. So we have, now for me, the ending value is 266.3523. That's what I got. So you would have got different answers. Okay, tell me, what did you get? Okay, we'll go one by one.
259.
Sorry? 359.
No, sir. 259,102.96.
259.
102.
102. Okay, other one? Anyone else? Extra?
So I got 3,630,204.
Sorry, how much? 6?
3,630,201.
3 million.
Yes, sir.
Okay, let's see. 3 million. 3 million.
3,630,201.
201. Okay. Okay. Then anyone else?
Sir, I got 3,656,417.
657,000.
3,656,417.
470. Okay. Okay. So whatever the number you got, now my numbers have changed now. So 154, 1,547,790. Okay, now go to the simulation. Remember? So copy it. In my case, I have copied into what you call B9. So whatever the number you get here, copy here B9 or whatever cell you know. Then from A10, in my case A10, we are going to run how many simulations? 1,000. We are going to run 1,000 trials. So generate 1 to 1,000 numbers. Generate 1 to 1,000 numbers. Now earlier case we generated 1 to 2,190 numbers. Now generate 1 to 1,000. Copy whatever the figure you got here in B9. So wherever you create, it could be anything, but now in my case I have B9. This is the number I got for this 30-year return generated by the simulation, and generate series from A10 up to 1,000. Up to 1,000. Okay, generated 1,000 serial numbers. Okay, can you move on? Everybody got this 1 to 1,000 trials generated? So generate 1 to 1,000 trials. Now we are going to simulate. Select. Now you have the n value you copied from here. Whatever the number you have. Select these two columns A and B up to 1,000. And now run a simulation. Data, what if analysis, data table, and go to input cell and then say OK. So you get your possible 1,000 possible scenarios. So in my case, I have got these numbers. Got it? Once you finish, tell me, I have to move on. Everybody got 1,000 series values? Your numbers here? Okay. Okay, let's do some calculations. Compute mean of this series. In my case, B10 to B1009. In your case, decide what depending on the numbers we want. So this is the series which I generated through simulation. Different ending values, the average is this, and also computed the standard deviation. So please compute mean and standard deviation of your simulated n values, whatever n values you got under your simulation from here to 1,000 trials. Everybody got the mean and standard deviation?
Yes, sir.
So we last, yeah, who is that? Eurasia?
Yes, sir. My mean is 4,331,460.
Yeah. How much?
4,331,468. 331,468. So 4,331.
Okay. Is that right?
Yes, sir.
What is the standard deviation you got?
4,105,4,105, 181.
Okay, next one.
Sir, I got 4,331,615.
You also got very close to other one. Okay.
Yes, I got a standard deviation of 3,892,000.
3,892,092.
92.
Mm-hmm. Okay, what about another one? Anyone else?
So I got an average of 4,309,276.
Okay, so that's it. What about your standard deviation?
3,616,578.
Okay. Anyone else?
So I got
Yeah.
1,154,400. 1 million for the mean. 1,154,000
154,000.
Yes, sir. 408.85.
Let's see. What is standard deviation?
88 million.
88 million.
Yes, sir.
You have to check the numbers, I think. It's a little bit outlier, like 88 million.
88 million.
Oh.
85,956.
55,956.
Yes.
8 million or 88 million?
88 million, sir.
88 million.
85,956.
85,000. Is that right? You put 8 million.
Yes, sir.
Is that right? 8 million or 80? No, this is 8 million, no?
No, sir. It's 88 million, 85,956.
88 million. There should be a zero here. Eight and 56,000.
956 there. No, 6 should be removed.
56. That's right.
Yes, now it's okay.
Now check. Anyway, little bit uncomfortable because this is little bit outlier like. So please check your workings because looks like a little outlier, you know, because 88 million. Probably check in your random series whether you miss anything, you know, because is there any outlier or anything like that. So you see a significant difference. Okay, we'll ask from another one.
So can I know how to take the first ending value? Because I think it's different, right?
First one.
Yeah.
Okay, first one is simply your original investment is now you compute. Did you compute the return? First return rightly? Random return. You generate a random return.
Yes, sir. I done it.
Okay. Now first value is. I am putting my case. B1
Okay.
is basically my original investment times 1 plus D10. 1 plus D10 means the return. That is return for the first year is 1 plus this return, right? That is G10. G10 is the first year return. Plus at the end of the year, I deposit another 10,000, right? Annually, I deposit 10,000 now.
Yes, sir.
So this is how I got. So if you look at this formula, check B1 star 1 plus D10 plus B dollar. Put dollar B $5 to get the absolute value.
Okay, sir.
So this is the year-end value for the first year, right? Then second year return is first year return. Sorry, first year value. First year value that is H10 plus second year return 1 plus C11 plus my 10,000 I deposit annually. Thereafter I can copy this, okay, because the third year value is this one. This one is H11 plus 1 plus D12, that is the return, plus year-end investment. So that's how you got it here. You have to compute this and this, then you can you can copy this.
Yes, sir.
So a little bit outlier. But anyway, check your numbers.
Okay.
You can't straight away copy from this point onward. You have to do this first because of the initial investment. Then do this from here onwards. You can copy. Sometimes I don't know whether you copy it from here onwards. Okay, can we hear from someone else? Just Anyone else got numbers? We have not got numbers. About those who haven't answered.
So I got, for the mean value, I got 4.389, 4,389,000.
Okay, you mean 4,389,000.
171.
171. Okay. Then
The standard deviation, 3,598,000.
3,598,000.
846.
846. Okay. Pulanjali, no?
Yes.
Okay. Anyone else? We can't hear from our gents. What has happened? Only ladies are in the forefront. All, our smart girls are answering. What about our smart gentlemen? Please, we can hear from one person. Can we hear from at least one gentleman?
4 million. Hello.
Yeah, you can tell.
Mean is 4,418,000.
Give me a minute. How much?
Mean is 4,418,000.
4,488,000.
938.
938. Okay, that's enough. Then
Standard deviation is 4,401,000.
4 million or 2 million?
4 million.
4 million?
401,000.
401,000.
113.
113. Okay. Any other gens? Ramesh, no, you just answered Ramesh.
Yes.
Okay, Ramesh. At least you saved our smart gentleman. Okay. Anyone? Taraka? Taraka, what is happening? Udayana? Can you hear from Taraka at least? Udayana? Huh? Are you in or are you lost or cooking or what? From home, very difficult, no? Helping your wife or whoever. Okay. Okay. So we got the whoever, I can't remember who is that. This big variation in number. Who is that?
So it's me, Lanka.
Lanka, please check your number because this is little bit outlier, it appears. If you look at all these numbers, they are not same, but going in the close region, So it cannot, I don't think it can be that much significant, especially the variation is substantial. So it looks for me, it's like outlier. So please recheck your workings again after the class and see what has happened. Still, if you get, we will look into that, later. So probably it is better if you could check, because if you look at all these numbers are somewhat in a one particular range, here 4,331,
Yes.
and here. So it especially I am very serious about this deviation. I mean, if you see this, you definitely are in real trouble, because say if you launch a product, liability product, and you are going to meet with the investment product, so how do you match this? So significant risk you are at. It's fun. So basically the idea is like, say, especially pension funds, retirement benefits, even within your bank there may be pension funds, so they may be giving a particular return. So for how do you structure it? It's very important. What could be the possible scenarios? So when you create a product, in turn you have to invest. On the other side, you have to create an investment product as well, or you have to invest in a particular product to give that return. If you look at an insurance company, that's how they do. how do they get a return? But they have intern return. If you look at EPF, provident funds, all they do. Even many other investment funds do it. So you want to find out, okay, in order for me to, you are guaranteeing somebody a fixed return. Okay, I will pay you this much at the maturity. So how do you ensure your investment derive that? And what is the risk to you? So this is a classic example. Okay, so now, for example, now on average, your investment will end up with, based on a simulation, on average, these ranges. So what would be my maximum, minimum average value I can derive at the end of the investment portfolio, right? Then also you can also deviation. So what would be now, for example, now in order for let's say you tell customer, okay, how many banks have similar investment products for the customer? I think so many banks are sending now these products. How many of your banks have these similar investment products? I think I got some information from a couple of banks giving a return. You invest with us this much, we will give you after 20 years this much, 5 years. How many of your banks? All of your banks should be having now. Because every day we get some leaflets asking to join. Okay. So with certainty, this is how much I have to pay for these people. So these funds I will use for this purpose. So my return will be this, or my value will be this, so that I can comfortably meet that liability, right? So that's the beauty of value at risk, and especially the simulations you can do. This is a simulation. I mean, okay. So again, then you can go and work. What would be now? You can divide your value into different percentiles. Percentile means 1% of 100. So here, if you look at 25 percentile, means if you can go to this function, you can work out 25 percentile. So that means my lowest 25% times like value at risk, the value will be 1,860,195. So the lower bottom 25% is this much. So that is 75% times I am above that, right? It's like value at risk percentile. Okay. So similarly, now let's say bottom 1%, the lowest 1% that could happen is it's like 95% confident my value in value will be 631, 651, right? Or after 30-year period. So 95% I am confident my value will be not below this one. Okay. So this gives you can compute percentiles the way you want. Okay. Using these numbers and see how the distribution looks like. This is very good for a investment manager to decide your risk position. So that's how you generate a product also. When your bank generates a product, before that you look at your return perspective. When I say I can give you this much to, let's say when your bank say I will give you 10% for 5-year deposit, you must get that 10% from your whatever investment, loans or whatever. So before issuing that, you must assure you have sufficient return to pay that 10%. After issuing, you can't say. So you will have to see what are the possible investment options and what are the risks and what are the worst case scenarios my investment could end up. Okay. Then only you can structure your deposit product. Because that is a fix. You can't, whether market interest rate goes ups and down, you have to guarantee the value to the investor. unless there is a clause that is linked to some index portfolio, right? So you can compute percentiles and see. Now this is like the lowest, the worst that could happen is 99% confidence, 1% chance that I would end up with 631, 651. I am 95% confidence I would get more than 886,560, right? Any more questions before we stop for a tea break? Because we conclude the simulation from
Please do the simulation again because I missed that. I think there is an issue in my calculation.
But I couldn't hear you properly because there's a sound now coming. Okay, tell me again, please. Tell me again, please. You asked something.
Simulation calculation because I got B10 to B1009, but the numbers I got is totally different from the others.
For this one?
Yes, sir.
How much you got?
It's in J column, sir.
Huh?
1,154,000.
Ah, this one?
The data, yes.
Okay. So what did you want to know? You got reason for it? That's what I said, you know. It cannot. Did you, when you work out the first n value, how did you work it correctly?
Yes, sir.
This one correctly?
Yes, sir.
A little looks, I mean, definitely uncomfortable. It cannot be like. No, I mean, this is possible, but this variation means, I mean, something wrong, I think. That is why, how can I see? Because there's no way I can check with you also. Is this right?
It's correct, sir.
Okay. Did you get this right? This number? Number means not this value. This formula,
Yes.
right?
Yes, sir.
Okay. Okay. Can you do this? You can send me, you know, screenshot of all
Sure,
these
sir.
formulas. Okay, just send me a screenshot. How do you do it? Like this one, this page? Then when you go to this cell, this page. So I want to see this formula. Okay, with formula. Now, for example, this data is right now. You put all this data right.
Yeah.
We started here. This is the first thing now we did.
Yes, sir.
This is the first thing. First thing,
Yes.
I need a screenshot of this one.
Okay, sir.
Then I need a screenshot of this one. Okay.
Okay.
I need a screenshot of this one and also final figure. Right.
Okay, sir.
And then when you ran the simulation, sorry, from here onwards, the
So
simulation
for the
part.
simulation, we have to select for the table from your
How,
case B2.
no, but what is the 30-year figure you got? Tell me. This figure, what did you get? Final figure?
Now it has changed.
Huh? How much? What is the figure you
Shall I
got?
tell the current figure, sir? Because now it's
Yeah, it's
changed.
okay, current figure.
7,466.
7,466.
Yes.
Okay, so that is the, I think that is very
Low figure.
yeah. No, I can't say wrong, but looks outlier. I can't say wrong. It looks an outlier. You know, in even simulation. Remember, when there could be outliers because this is something system generates. Suddenly there may be outlier. So that's what I will do. So I'm not saying wrong. So I want to check. So can we have a chat after you sending screenshots so that I can see your numbers and whether something gone wrong. Can we do that?
Sure, sir.
Okay. You send me.
Can I know your mail address, sir? Then I can send.
Yeah, I will. My mail address is jp. RK at cbsl.lk. jprk at cbsl.lk.
Okay. Okay.
So mail me all these screenshots. I need to see, Okay, then we will see what has gone wrong. Or maybe a complete outlier. Okay.
Okay.
Okay. So, any more questions? Anyone else need anything to clarify? Because we conclude the simulation, then we will move on to a new area. Hope everybody is comfortable with historical simulation. Very easy. Remember, if there is a fraction, you have to interpolate. Remember, interpolate. Usually, you can approximate if it is a close one. I'll say, if you want to find out the 3.95th item, better you take the fourth item. If you want to take the 4.12 item, take the fourth item. Whichever side, lower or upper. But suddenly, if you want to set the 4.5th item, then you have to interpolate, which is in between, not much closer to either side, or 4.6th item, or whatever. So you should be able to find out the value at risk for any given confidence level. Then variance covariance analysis, you can do it again using the data, computing mean and standard deviation for single investment and the portfolio investment. Okay, so then we moved on to the Monte Carlo simulation, right? Okay, so you should be able to work out anything. I just took two examples of S&P index. If you follow that one, so anybody, some investors follow an index, not just their portfolio is based on an index. They select investment from index and allocate as per the index. Maybe you have again some funds, even your investment portfolio part of it may be like that. So that we can do Monte Carlo simulation. Then we also looked at this question about investment over a investment horizon. What would be my end value? So this is very good when you launch new products. Like now, so many companies now used to use retirement plans. So many banks, they offer retirement plans for the outside. I mean, sort of a retirement plan. They say, okay, you put initially 100,000, you put 10,000. I will give you this much after 30 years, 15 years, 10 years. I think most of your banks are now in that area as well. So then, how do you guarantee your return to pay your investors who are putting money in your bank, like depositors? So then it's very good to look at Monte Carlo simulation and see your investment values. Okay. So almost 11. So we'll stop for a tea break and we'll move on to a new area of hopefully ALM. Okay. Thank you. So we'll meet around 11:15, 20. Okay. No? Okay. So let's move on to the liquidity risk. So what is liquidity risk? So what is liquidity? It's a bank capacity to fund increase in assets and meet both expected and unexpected cash and collateral obligations at a reasonable cost and without incurring unacceptable losses. So if you look at the different types of risk we discussed so far, liquid risk appears to be one of the most important risks from a bank's perspective. Each and every risk is important, but when you consider the survival time, in a case of liquidity risk, where you have high liquidity risk, that means your survival time is very minimum. So on top, now if you look at credit risk, that again have caused problems to the bank in the medium run, but liquidity risk is far more powerful in ending up or closing up a business of a bank. So that's why the bankers are very concerned in managing day-to-day liquidity at an appropriate manner. So liquid risk is the inability of a bank to meet such obligations as they become due without adversely affecting the bank's financial condition, right? So it's inability of banks to meet such obligations as they become due without adversely affecting the bank's financial condition. Effective liquid risk management helps ensure a bank's ability to meet obligations as they fall due and reduces the probability of an adverse situation developing. So this assumes significance on account of the fact that liquid crisis, even at a single institution, can have systemic implications. Okay? So it's very important from a bank's perspective, because one of the main reasons a bank is exposed to very much significant or very much higher risk in terms of liquidity opposed to any other institution. So what is the main reason? Now this arises of one factor. Now liquidity is there for every institution, but from a bank's perspective, financial institution perspective, this is prominent, risk. What is the reason? Anyone? What is the reason for this? Can someone tell? All of your bankers. What is the major reason for this? I mean, liquidity is common for all institutions. If you are doing any business, liquidity is important. But for a bank, it is much more important.
It will affect the bank's reputation.
Yeah, but no, what I'm asking is, why is that? Why is that? If I know that will affect, but how? Why this liquidity arise in the case of a bank? Why it arise opposed to a normal institution? Even if you look at any business organization, liquidity is important, and liquidity is important. But the bank's liquidity is very important because of why they are exposed to such a significant risk. What is the reason? How it arises? That's why you have to be very careful. Anyone?
Loss of public confidence.
Huh?
Loss of public confidence.
How it arises? Yeah, public confidence will be lost if you don't have liquidity. But the main factor that lead to liquidity risk in a bank.
Customers are lifting their money.
Who told maturity means, right?
Lanka.
Huh? Lanka.
Lanka.
Yeah, exactly. Because if you look at the funding structure of a bank is quite different to funding structure of any other entity. Banks, look at all of your bank's financial statements, balance sheet. How do you fund? Your funding coming from mainly depositors. If you look at your funding, you have deposits, you have borrowings and capital. Okay, so those are the three sources of funding for a bank. So the major portion of your funding is coming from the deposits. And also in deposits, what is the structure? Okay, the maturity. Your deposits are short to, most of are short in the sense 3 months, 6 months, 1 year, maybe maximum 2 years, and less long-term deposits. So you are focusing short about 1 to 2 years, and your opposite side, what is the maturity? Opposite side, your liability side, short term. Short means 1 to 2 years. But on your lending side, asset side, what is the maturity?
Normally 5 to 10 years, short term.
Yeah, so it's little bit medium to long term. Yeah, so that is the maturity mismatch we are talking about. So inherent risk arising from the maturity mismatch. Okay, inherent risk arising from the maturity mismatch. So that is the importance. So your task is managing that. If you can't manage it properly, collapse is imminent. Collapse is no way you can survive. That's how many bank failures. The root cause is liquidity. Whatever others are long term. You can manage now. If you look at credit risk, high NPLs, provisioning, all this manage over time. But liquidity means instantaneous. That will lead to loss of confidence. When you have a liquidity crisis, when you can't pay, that will lead to loss of confidence. But important point is the maturity mismatch, inherent maturity mismatch, which could result in banks' inability to meet short-term liabilities with their medium to long-term assets. So the responsibility of your ALCO, asset liability committees, are that how you can manage it. You can manage it. Okay. So that's why on top of all the risk, liquidity risk is eminent. Not only here, any country, So that's why in the new Basel report, after the financial crisis in 2007-9, they brought in two new ratios for liquidity also. Earlier, there were no ratios for liquidity, only the capital adequacy. But what were the two ratios for the liquidity? Can someone tell? Two important regulatory ratios brought in.
SLA?
Huh?
SLA?
No, SLA was the domestic one, but international ratio, two ratios. Now, I think all of your banks are supposed to comply even in Sri Lanka. Two important ratios after 2007 crisis came in as an international standard. I mean, SLA is a domestic ratio to measure the liquidity, statutory liquid asset ratio. But what I'm asking is the international standard. Now, capital adequacy, which has been there since early 90s. But for liquidity, because when you look at 2007-9 crisis, the root cause was liquidity. I mean, it started from, of course, subprime crisis, but then liquidity was the major concern. Can someone tell? Now, it's fully applicable in Sri Lanka right now.
Tier 1 and total capital ratios as per the Basel requirement.
Sorry? Yes.
Tier 1 and total capital
that is for capital. That is for capital. I'm asking for liquidity. Capital has been there for some time now. But I'm asking liquidity, what are the two key ratios?
LCR, sir? LCR and SFR?
Yeah, exactly. Who is that, please? Felicia.
Yes, sir.
Yeah. LCR, what is LCR stand for? Short version, you know, long version, not sure. Liquidity coverage ratio. What is
Yes,
that one? What
NSFR.
NSFR. What is NSFR?
Net stable funding ratio.
Net stable funding. So those are the two ratios which Basel introduced after 2007-9 crisis. So which is fully applicable in Sri Lanka right now. I think you have to be fully compliant. I understand is since 2019. Since 2019, I think it is fully applicable in for Sri Lankan banks as well, in the Sri Lankan context. So Sri Lankan regulators, bank supervision regulator has given you the relevant. Probably we will touch on that when we come to the very last part of our course, the Basel capital adequacy. So we will look at that, but just for your information. So that's why the liquidity is so important, right? So, so liquidity of banks arises from the funding of long-term assets by short-term liabilities, thereby making the liabilities subject to rollover refinancing risk. So it depends on individual bank and characteristics and policies. So it may vary from one bank to another bank based on the different structures of banks. Having a large amount of liquid assets, so improving the matching of asset and liability flows reduce the liquidities. So one way to do that is to ensure you are not exposed to significant liquidities is that have a large quantum of liquid assets. But what is the problem from a bank's perspective? What is the problem? The best way you have some adequate
income is it?
Sorry? Yeah, you can tell. I couldn't hear you.
Maintaining high amount of liquidity means you missing your investment income.
You
missing your investment income because when you are investing in short term or overnight repo or something, you are getting very low interest rate. But when you are investing,
exactly. So it's a question of your liquidity and profitability. So as you said rightly, the high liquid, because if you have more liquid assets, then all those liquid assets are giving a low yield generally. If you look at the best, what is the best liquid asset you have in your bank? Best liquid asset, can anyone tell?
Cash in hand.
Yeah, exactly. Cash is the best liquid asset. So you can put all these, funds in your vault in cash flow. You are very happy. But what is the problem? No return.
Zero return.
No return, zero return. Just put your, even if you have a home about 1 million, 2 million rupees, put in a pettagama and keep it. Best liquidity. Those days you have pettagama, you know. Good old days, our good old kids and kids used to store cash in a pettagama, in a box in house. But now we don't have it. But you can put it in a safe lock or anything. But you don't get any return. But you are liquid. Anytime you can take a bundle out and do anything what you want. But no, so but from a bank's point of, so liquidity and profitability you have to manage carefully. So even in a general liquid asset, you put it in a bank, your bank, your money put it in another bank, again, low return. Okay, so if you want to generate more return, you have to lend. So, but lending does not have any higher liquidity. So it's very important as bankers, how do you manage it? So you want to ensure you are not illiquid, or you are not exposed to significant liquidities, as well as you make a return, appear to be a good return. Okay. Okay. So it is very important from a banker's perspective to manage all these things together. The liquidity, profitability, solvency, all these are very important. How has liquidity changed? Change in the traditional business model. Okay. Now, especially if you look at about 30, 40 years ago, even 20 years ago and today, the business models have changed. Okay, business model have. Even people thinking has changed. You see, the people are also educated today. And different opportunities in the market. So that the ability to banks to generate or create deposits also become a threat now. Because the alternative opportunities are there for the investors, people. Okay. So if you look at few years ago, when somebody earns something, want to save something, what they do? What usually they do? Or what options they have? They had what options they had about 20, 30 years ago? If you're born in 80s or somewhere, 70s, 80s, and at that time, what was the options available for a person when you earn something extra? And the thinking, and how the banks followed it. Well, people were not aware of any other opportunities because there were no opportunities. So simply, whether the bank give 1%, 2% return, you put it in a savings deposit and keep it for lifetime. So banks have a very stable, low-cost deposit base. Okay, now if you look at especially like the places like NSB. Anyone from NSB? No?
Yes, sir.
Okay. You are Miss?
Anjali.
Anjali?
Yes.
Okay. Now, if you look at your bank, now originally there was a core deposit base coming from postal savings account. Yes? Okay.
Yes.
That was a core base for NSB. Because people have what you call past savings book or whatever you call, and simply they forget about it. They are not going to take it. That is their hard-earned savings. They are not worried about the return either. They simply go to the post office and put some 10 rupees, 20 rupees. So these are core deposit bases. Very low cost. Because they didn't have any other opportunity. No? Either they can keep money in the till or go to bank and deposit. So thereafter, that is, if you look at some people, they have never withdrawn. It's a hard or low cost base for the bank. So bank then gives to the other borrowers housing loan or whatever at a high interest rate. So, but over time, this has changed. People are educated. People have other opportunities. Okay. The people who have money now not put all this money in your savings account, which gives about 2%, 3% return. They can get a better return investing elsewhere, other products. So traditionally, the model has changed that you are no longer can depend on low cost deposit base. Okay, low cost deposit base, and also there are other factors which has led the bank's inability to attract more deposits. If you want, then you have to pay higher return. Then it's a compromise of profitability. Then technological advances. How the technological advances has resulted in banks to meet the liquidity, more liquidity. Tell me a few examples. Now, technology is good. Yeah. Yes. Someone want to tell something?
Online banking.
Huh?
Due to online banking, the liquidity risk is more.
Yeah, online banking. Yeah, all these machines, ATMs, all those. You need to have sufficient liquidity buffers. You see now I mean, 20 years ago, or maybe around 20 years ago, is there any way, if you need some cash on a weekend after 2:15 or 2:13, after bank close for operations, till Monday morning 9 o'clock, can you get any cash from where? 20 years ago?
No.
Huh?
Can't.
You can't, unless you rob the bank. Okay? You can't do. You have to wait till Monday, 9 o'clock or 8:30 till bank opens, because you have to go to the branch, you have to pay, fill a slip and get the money. You can't do it. But today, you can go to ATM, you can get up to whatever, any ATM, not only your bank, any ATM. I can go to other bank and get. So every bank is not just their customer, they have to get to the other customers also. So if I have account in HNB, I have a closest branch commercial bank, I will go to the commercial bank ATM, get the cash. So commercial bank has to get not only the commercial bank customers, all the customers which are linked to that Lanka Pay or whatever. Maybe they are charging a fee, whatever, but still. So technology itself has created advantages in certain area, but liquidity fund, you have to have more liquidity. Competition. You are in a competitive business now, more banks, more products. So that again has led to your risk profile, liquidity risk profile. So there are so many factors. And if you look at liquidity broadly, two sides, asset liquidities and the funding liquidities. Asset liquidities designate the exposure to loss consequent upon being unable to effect a transaction at current market price due to either relative position size or temporary drying up of markets. Now, whenever you need liquidity, now you can generate liquidity from the assets. But either assets are illiquid, or even if liquid, cannot sell due to current market prices. Even some certain liquid assets, fairly comfortable liquid assets, are not in a position to sell comfortably under certain market conditions to create liquidity. So that is called the asset side liquidity. So the liquidity is arising from the asset side in the balance sheet. Then funding liquidities is the exposure to loss if an institution unable to meet its cash needs. So you don't have to fund it, your obligations. Okay. So then it will lose the confidence and create, panic among your depositors or creditors, and could lead to a bank run. Okay. So, whenever such funding liquidities arise, you have to liquidate assets. Okay. So which again then have a problem if you have any concerns mentioned previously. The markets are not good at that time, so that you can sell, but at a fairly high loss. Right? So we call fire sale prices. I mean, you can sell asset, but at a very significant loss. You see? Now let's say you have your own car worth, let's say 10 million worth car. Okay. So suddenly you need to sell it. Okay. So if you want to sell that car, suddenly probably you may not be able to match your normal market price. So of course you have to sell at you can sell, you can easily sell, but only thing is you can sell it at the price which is being traded usually. So it's called the fire sale price. So there are different sources of liquidities, internal and external. Internal own and third party as a result of third party. So there are so many risks which we are not going to discuss each and every one briefly. On balance sheet risk, off balance sheet risk as a result of structural cash flow mismatches on the both assets and liabilities. Okay, on the both assets and liabilities. Okay. So on the asset side, there could be asset concentration risk. So what do you mean by asset concentration? It is there in the liability side as well. So what is asset concentration risk? What is liability concentration risk? Can someone tell?
Too much depend on the same thing. For example, if we, for asset side, if we giving loans for the same, for a one product. For example, if we have EPF loans, mortgage loans, more than 50% or somewhat amounts total from the EPF loans, we said that it's too much concentration.
Okay.
This is asset concentration.
Okay. So asset concentration is you have too much concentrated on one particular sector, product, or anything, market. So we are exiting from, that market is difficult at a difficult time for the purpose of liquidity. Now, for example, I think NSB, who is that? Lanka will take Lanka, no?
Sir.
Yeah. You will tell that your loans may be mainly housing, no? Housing loans. You may be having mainly housing loans. Okay.
Yes.
Housing loans. So your focus will be more than 5 years, no?
Yes, sir.
Up to which maturity your loans will be up to 20 years, 15 years?
Yes. 20 years.
20 years. So you see, now for NSB, it's a clear asset concentration because in the case of liquidity, it's a tough task. So you can't ask people to repay, no? So your concentration is on long-term illiquid housing product, which is not liquid, right? So likewise, you should not have overconcern. So probably they are maybe managing with a long-term liabilities, like maybe long-term deposits. Probably in the case of NSB, definitely you have a higher deposit. I mean, large amounts of deposit, which are maybe 3, 4, 5 years, no, compared to a normal commercial bank. Similarly, liabilities. Now, liabilities also, it's not good to concentrate among few products, few parties. Okay. So suddenly, now this has happened in certain banks, because in order to attract big deposits, sometimes banks depend on few large depositors. So they will say, I will give you a good return. Put me 200 million, 300 million. So they will put. But what is the risk? What is the risk? Suddenly, a couple of them come and say, we want to withdraw money. Sizable amount. So then you will have a problem in terms of liquidity. Okay. So it's very important to have a diversified portfolio. When you are concentrated, it means low level of diversification. So it could be on the asset side and liability side both. Then liquidity risk arising from the market. So that market is very dry, you cannot sell your assets. You cannot sell your assets because of the market conditions are not good. That can happen from the liability side. It's very difficult to mobilize liquidity from the market by way of funding because of markets are also drying up. Interbank market dry up. So it could be either way. Customers option risk. Because now, say for example, when you give guarantees, now for example, guarantee, then suddenly those guarantees materialize. Then you need to have adequate liquidity or different options on the part of your products. Similarly, on the liability side, non-anticipated termination of deposits. Sometimes, especially the borrowings, not really in deposit, but in Sri Lanka, sometimes you may have option. When you issue debenture, there is option. The customer can demand prior to the maturity. Then you have to be ready with funding to meet such demand. So that is called customer's option risk. So it could be within your bank, either on the asset side or in the liabilities side. So it is within your bank. Then third party. Third party means as a result of credit risk. Now, when your customers default, what happens? You will not get the forecasted cash inflows. So the original risk is the credit risk, but what can it cause? Substantial liquidity risk. You see, the original risk is credit risk. When customers don't pay, it's a credit risk, but would result in liquidity risk. Interest rate risk. Due to the interest rate risk, you don't get adequate liquidity, expected cash flows. Okay. So whatever outcome risk means, the expected outcome is deviating from, actual outcome deviate from expected outcome. Currency risk. So there are so many things: innovation risk, operational risk. All these, risk could lead to some liquidity problem. Okay. Then external political risk, event risk, systematic risk, market risk, other risk. Even sudden, maybe, for example, now certain period, maybe in Sri Lanka this may have not happened. In some countries, suddenly the changes in political parties led to certain hard decisions. That fear of your deposit being controlled. So suddenly there may be unexpected withdrawal. Now people, it's like people expecting fuel price to go up. What happened before that day? All people go and pump fuel, try to pump fuel. You see, likewise, so people start withdrawing. So that could lead to liquidity risk when everybody starts withdrawing. Natural liquidity risk can come. Okay. Unexpected event could lead. Okay. Systematic market, which is derived from the market. Okay. Or any other risk that could lead to liquidity risk. So classic example I can think of is, I don't know whether I mentioned this to you sometime back at the first classes, a rainy day in I think this happened in I think in Taiwan or somewhere. Okay. Yeah, I think Taiwan. Rainy day. Some time back, long ago. At that time, even Sri Lanka, we didn't have ATM machines, but in I think this happened in Hong Kong. Sorry, not Taiwan, Hong Kong. Hong Kong, so they have the ATM machines freely available. One rainy day, there was a bus stand and near a ATM machine, right? So what happened? A particular rainy day, because of the rain, some people are getting cover under the bus stand, and there were people were facing different directions. Some were facing the roadside, some was in the bank side near ATM. So there were some people taking cash, but there were quite a number of people. It looked for some people like a queue. And some people, when you pass that place, it looks like a queue. People are in a queue to get the cash from ATM. Okay. So Hong Kong, usually people don't talk much. They don't talk to each other. So what happened? Then they assume things. Even in Sri Lanka, sometimes you go on the road, see, if you go to hospital junction or anything, you see somebody is looking at the top of a tree. Then what happened? There are two people looking, there's a big tree also looking at the top of a tree. What happened? What do you do? I think you all also start looking at the tree. Everybody start looking at the tree. But if you ask somebody, why, what is the reason? No one knows. So they just look for a few minutes and vanish. Because we used to follow things. Then people assume, because it is not a common scene, because in Hong Kong, you see, because your bank branches are close by, you can get cash from ATM without any problem, without being any queue. But it was a rare case. In fact, there were no people, but it looks like a queue because of this. So many people near the bus hold and under the cover. So then people reacted. So what they did, some people, let's say I have an account in that bank. What did I do? I presume, oh, there must be something wrong with the bank. That's why people are queuing. So what I did was I also got onto the queue and start withdrawing money. So within few minutes, people started withdrawing money from ATMs all over the country from that particular bank. You see, I mean, this is totally unexpected event risk. And what happened? So all ATMs went short of cash. Then when the ATMs are no longer there, what the people did? What did they do? Can you think about it? Anyone? They came to the branches and asked for money. So within a period of 1.5 hours, bank went short of cash. So bank became bust. So then it was a huge liquidity crisis, no cash in the bank. Then ultimately, the bank management had to have serious discussions with the central bank of Hong Kong. Okay, and then there were media conferences to calm down the people, and the central bank had to pump liquidity, and then following day, the bank started gradual business. No problem at all. Nothing was wrong in the bank. So you see how people reacted. Then because no bank has liquid cash if there is a greater demand. Any of your bank does not have. Okay. So that's why liquidity is so dangerous. So internal and external factors in banks may potentially lead to liquidity problems. High off-balance sheet exposure. So when you have high contingent exposures, you never know those will materialize. Now, can you give a classic example of a very prominent off-balance sheet risk item in your banks? Very prominent. And very difficult for you all to manage. Can you all give me? off balance sheet. Very famous product. But that is off balance sheet. Would lead, if you have many more such, exposures, you have to be very careful. You can give in one word at least. Anyone? Can someone tell? Classic example. A commitment. What is a commitment? Can you give one product which has a commitment? Specific, very famous product in your bank, which has a both on balance sheet element, off balance sheet element.
LCs?
Huh?
Letter of credits?
LC you have off balance sheet, but a product which has a on balance sheet element and off balance sheet. LC will become on balance sheet after, LC, settlement or whatever not happened. But a classic product which has a on balance sheet element, off balance sheet element. Danger is the off balance sheet part. Classic example.
Credit cards?
Huh?
Credit cards?
Credit card, there is no such, there is a, off balance sheet element, but on balance sheet will be subsequent. But this has both, simultaneously both.
Letter of guarantees?
Sorry?
Letter of guarantees?
Guarantee also one side. It is not on balance. There is no on balance sheet part. It's off balance sheet. If the guarantee you need to, somebody exercise only, you have to pay, then it will be on balance sheet. But this particular product has both features. Very famous. Very famous.
Undrawn credit lines?
Huh?
Undrawn credit lines?
Credit lines. Okay. Yeah, credit lines can have, but very specific, very known product I am asking. It could be, credit lines also could be. But a specific product, I mean, credit line is generally you get the liquidity, You don't have any problem. If you have credit line, you get liquidity. But here, you are exposed to liquidity. No one? Bank overdraft.
Bodies.
Overdraft. What is overdraft? Tell me what is overdraft? Huh? Overdraft. What is overdraft? Overdraft is a commitment given by bank to a customer. Commitment given by bank to a customer. Up to particular limit. Let's say I go to a bank and ask for overdraft, but the bank say, okay, you have overdraft of 500 million. So tomorrow I go and withdraw 200 million. So then it is on balance sheet. Then what is the off balance sheet? Balance 300 million. So simultaneously I have on balance sheet element, off balance sheet element. So withdrawn part is on balance sheet. Liability or in your bank is an asset. Undrawn money in your bank is a commitment. I can at any time withdraw it, isn't it? Anytime I can withdraw it within the limit. So that is the danger. Undrawn part is the dangerous part. That is a commitment. So when you have high off-balance sheet exposures, especially type of commitments, you need to manage liquidity carefully. Because let's say there are 10 such overdrafts, any of us come and withdraw at any time, no prediction. No prediction. No one can, Bank does not know at what point all of us will do it. But bank has to be ready with the liquidity. Okay, so that is a classic example of both on and off balance sheet. All the others have many off balance sheets can create LCs, guarantees, all those. Okay, but here the danger is you are committed, and anytime. But guarantee, there's a when it's a guarantee, you need to somebody has not honored and it is claimed, you have to pay the guarantee. That's again create liquidity problem. The banks rely heavily on the short-term corporate deposits. That's again a danger side. Short-term corporate. A significant gap in the maturity dates of assets and liabilities we discussed. Banks' rapid asset expansions exceed available funds on the liability side. If you look at certain failures, classic example is rapid expansion. We call over trading. So if you want to expand with the internal funds or capital, not the liability side. Okay. So sorry, not through the deposits. So classic reason. Concentration of deposits in the short-term tenor. We discussed earlier also. If you concentrated your deposits with shorter maturities, there's a natural liquidity risk. Less allocation in the liquid government instrument. So you don't have sufficient liquid assets such as government securities. Fewer placements of funds in the long-term deposits. So not adequate long-term deposits. External factors, very sensitive financial markets deposits. So these are within yourself. These are something which arise as a result of your operations. External sensitive financial markets depositors. Because if you live in a market very sensitive to information, depositors, definitely you are exposed to significant risk. So that classic example is Hong Kong case. I mean, people are panic, sensitive to some event. So we assume things and started withdrawing. External and internal economic shocks. Okay. Due to some shocks in the economy, unexpected shocks in the economy. So that could lead to people demanding more, or maybe your ability to manage both asset and liability side liquidity is difficult. Economic slow or low economic performance. Decreasing depositors' trust on the banking sector. Now, in certain periods, certain countries, the people lose confidence due to many reasons. So that will lead people to move away from the banking system. So it could lead to higher withdrawals and ultimately lead to liquidity problems. Non-economic factors, sudden and massive liquidity withdrawal from depositors. So you never know. Suddenly, whatever reason, there's a massive liquidity withdrawals. The depositors. Then again, you will have some pressure on liquidity. Then unplanned termination. Now certain banks depends on government deposits. Suddenly, the decisions are taken to withdraw those deposits. Then again, you will be in trouble. Okay. So there are many internal as well as external factors that could have impact on liquidity. Then there are different methods to measure liquidities or look at liquidities from different angles. There are few methods I have highlighted: balance sheet liquidity analysis, the maturity mismatch approach, cash capital analysis. Okay. So we look at each one separately. The balance sheet liquidity analysis is a very simple way of looking at different balance sheet items liquidity. Because if you look at balance sheet assets and liability, they have different liquidity level. Okay. Then maturity mismatch, the modeling and behavioral adjustments, and bank's ability to fund assets on a fully collateralized basis, cash capital analysis. So this is a very basic, simple example of how do you look at the balance sheet, assets and liabilities in terms of liquidity. Okay, now look at comparative banks, two comparative banks. The first bank, Bank A, loans and receivables, investments and others 50 million, and B 100 million. Both banks have 110. Okay, let's say 110 assets each. Then trading assets, which can be traded, 30 million and 10 million in the Bank B. Reverse repos. Reverse repos are generally short-term assets which create liquidity, 30 million and 0 million. Then if we move on to the liability structure, the banks A, non-bank deposits, so deposits mobilized from not by the banks, 20, and in the case of Bank B, 70. Some certified liabilities, 20 and 10 in the case of Bank B. Equity 10 and 10, both banks. Unsecured bank deposits, 20 and 15. Trading liabilities, 30 and 5. The repos, 10. So, when you look at the structure, what do you feel about the two banks? So this is how you look at a balance sheet. Different assets and liabilities in light of liquidity. So how do you feel about the two banks? How do you all feel? Two banks, A and B. Any thoughts, views?
Bank we have high asset concentration on loans and receivables, and also they have too much concentration on non-bank depositors as liability.
In terms of liquidity, can you say anything? Okay, given all those things, what about liquidity between two banks? Can you comment on liquidity? Only with this information, can you tell something?
If the non-bank depositors withdraw their deposits, the bank B have high liquidity risk.
Bank B.
Sir.
Okay. Okay. In general, I mean, when you look at the numbers, we are only with these limited numbers, but with these limited numbers, it looks like Bank B is exposed to higher liquidity risk than Bank A because of concentration in the liquid assets. Now, if you look at the bank's exposure to loans and receivables, which are somewhat less liquid than Bank A. And Bank A has more trading assets and more reverse repos, which are short-term liquidity instruments than Bank B. So on the asset side, Bank B is less liquid than Bank A, or Bank A is high liquid than Bank B. On the liability side, again, the non-bank deposits means the depositors to others, which are subject to withdrawals, is much higher. So liability side risk also higher in the case of bank B. So it has both asset side and liability side risk compared to the bank A. So in terms of liquidity, bank A is less risky than bank B. I mean, just for your analysis, so how we look at the balance sheet liquidity from a bank perspective. So it's very simple, looking at the numbers which are reflected in the balance sheet in terms of liquid assets and liabilities. But there are several limitations. There is no time dimension, no statement about time frame when position can be liquidated, because here we don't know time frame. We say these are liquid, but how far? What is the time frame? I mean, take example of this reverse repo. Now, how soon we can liquidate? Okay. Impact of accounting rules. Now, these are book numbers we looked at. Accounting figures might not reflect real financial institutions' cash flow. So there is no way of interpreting in terms of actual cash flows. So these are reported in the books. Off-balance sheet commitments, off-balance sheet positions are not reflected on the balance sheet, but might expose financial institution to significant liquidity. Now here in the balance sheet analysis, we only look at the on-balance sheet assets and liabilities. So remember, I told earlier, the off-balance sheet can also create significant liquidity risk. Then marketability of securities. Securities are shown on balance sheet according to their market value, which are not sufficient for proper estimation of liquidity risk. Commercial papers, sometimes stable and volatile products are put together on balance sheet. So if you look at commercial papers, it's also short-term loan facility. Short-term loan facility like 3-6 months. In certain countries, commercial papers have somewhat higher liquidity, but in certain countries, it may not have adequate liquidity. But again, stable and volatile products are put together on balance sheet. Non-bank deposits, insured, uninsured, or secured, unsecured, may not separate. Okay? So there may be limitations when you look at holistic view or different products as a whole in terms of liquidity. But it gives a general overview about banks' ability to bring or tells about the liquidity of a bank. So it's not complex, because anyone look at the balance sheet, have a sense of feeling about liquidity, knows, okay, how much liquid assets I have, how much liquidable liabilities I have, so that what is my risk level. Then maturity mismatch approach, standard technique for identifying liquidity exposure relies on a gap time profiles. Okay, so it's a gap time within a particular period. Identification of excess or deficits, existing loans and deposits. So spreading the control in liquidity risk implies spreading funding over time and avoiding the need for market funding. So there the idea is the funding to be spread over time. You see, so whenever you fund, that will be spreaded over time and avoid need for market. The risk is that if there is any liquidity, higher liquidity demand, you have to go to the market. So when you go to the market at a difficult time, it's very difficult. So in this manner, when you spread the funding over time, matching the your liability side, then you can manage comfortably without going to the market. So maintaining a cushion of liquid short-term assets. So to achieve that, always maintain a cushion of short-term liquid assets. Now this is a simple example. Now day 1, day 2, day 5. Okay. Now you have assets, okay, on the day 1,000 and liabilities, equivalent liabilities 1,000. Okay. Then you need, there is a demand for withdrawal up to, for liability settlement of 200. So liabilities will go down to 800. Okay. Then you realize part of it by dispose of asset. Let's say assets will come down to 900. But then there is a gap of 100. Okay. Gap of 100. So how do you manage it? Okay. Well, assets come down by 100, liabilities come down by 200. So there's a gap of 100. Then when you move on to the third day, liabilities will further reduce to 700 and assets will further reduce to, liabilities will further reduce to 500, assets will further reduce to 700. Okay. So there will be further 200 million assets decline and 300 million liability decline. So we call the amortization. So the gap again is 100. Okay. So likewise, you can compute over the next 6 days what is going to happen. Okay. What is going to happen? 400, 650 and 400, 500 and 350, 300 and 100. And when you forecast, then your marginal gap will be 100, 250, negative 100, because they are your asset decline is higher than the liabilities, so negative 100. So which will bring in capital, bring in cash flow, then again 50. So the cumulative gap is 100, 200, 150, 150, and 200. Okay. So this gives a feeling about the maturity of assets and liabilities and consequent gaps that arise which need to be managed. Okay. So when you identify the gaps, so you should have a mechanism to manage that gap, right? Okay. So cash flow matching, that is the third methodology. Okay. Now, so how do we fill a gap, okay, between asset and liability? Now, when you identify the gaps now, so there's a gap of 200. Let's say this gap 200. How do you manage it? So that's the important part. Now, let's say you have asset 1000, liability 800. So there's a gap of 200. Okay. Similarly, so you have assets 750, liability 650, gap of 100, and so on. Okay. So you need to generate more funding to meet your asset. Okay, so you create 800 to fund 1000 assets, but how do you fill the 200? So you can go for different funding sources. You can create a debt. First debt 50, second debt 50, third debt 100. So total funding 200. Now here you expand the balance sheet to 750, but you can fund using existing liabilities 650, but there's a gap of 100 to fund the balance asset side. Okay, so then you can again go for two different debt sources. I mean, this is an example. You can say debt 1, debt 2, debt 3, whatever. Here again, one debt. So once you fund the gap, so there won't be any gap remaining for you to fund, right? Okay, so that is called cash flow matching. Once you identify the asset expansion and liability expansion, so funding through liabilities, again you have to find out how do you manage the gap. Then this is something introduced by Moody's in 2002, long ago. What is called net cash capital analysis. Where net cash capital position equal long-term funding minus illiquid assets minus illiquid securities. Okay. So generally, if you structure a balance sheet as per different asset classes, you have collateral value of unencumbered assets. So that when you have unencumbered assets, those can be used for creating liquidity. Let's say you have a treasury bill portfolio, treasury bond portfolio, which is not encumbered. So anytime you can keep them as collateral and obtain, that's like a reverse repo. Sorry, not reverse repo, you can repo them and get money. So the collateral value of unencumbered assets. So you can generate liquidity, illiquid assets, and other contingent outflows. Okay. In liability side, you have short-term funding sources, non-core deposits, and you have core deposits, long-term funding, equity, and whatever the contingent funding capacity, which is in the balance sheet. Okay. So the difference between the collateral value of unencumbered assets and the short-term funding and non-core deposits is called the cash capital. Okay, so the collateral value of unencumbered assets minus short-term funding and non-core deposits. Because the core deposit, you don't have liquidity risk. No need for immediate cash. Okay. So if you can maintain that at a comfortable level, you can manage liquidity. So that is something developed by the Moody's, which is called the net cash capital analysis. Whenever your collateral value of unencumbered asset decreases, then your cash capital will decrease. Or whenever your short-term funding and non-core deposits increases, the cash capital will come down, right? Now again, from a balance sheet perspective, now collateral value of unencumbered assets equal liquid assets excluding haircuts, then you have cash and reverse repos, which are generally considered as the liquid assets, okay, total liquid assets. Then you have volatile liabilities, what is called subject to demand, those are the volatile liabilities. Short-term funding, whatever short-term funding, non-core deposits, like I mentioned earlier, non-core deposits, and repos. Okay, these are again short-term. Okay, so those are called total volatile liabilities. Then we have illiquid assets on the asset side, fixed-term assets, structured funds, haircuts. Then on the liability side, volatile liabilities also. Sorry, non-volatile liabilities. That is core funding plus liquidity. Medium term funding for customer deposits. And then we have liquidity. That is the total on the on-balance sheet. But on the off-balance sheet, there are commitments to lend and steadily available lines of credit on the liability side. Okay. So this will give a picture about your ability to manage liquidity in the day-to-day business, right? So this is called the cash capital analysis, right? Any questions? Anything you need to clarify? I think almost we are on time. So we'll stop there for the day. So I'll go through liquidity risk management from next, of course, next day, next 2 weeks. I will not be taking up any sessions with you all, but there will be a new session on forex risk, foreign exchange risk. So I will start the balance part of today's lecture after 2 weeks when this forex session is over. Okay, so please go through your handouts which we discussed on the interest rate risk and so on. I will distribute this handout also to the institute. So we will continue from where we stopped today after 2 weeks. Any questions? In the meantime, I will have a look at Lanka's problem also, and then I will communicate with you as appropriate. Okay. Okay. So if you don't have anything, we'll stop for the day. So I will see you after 2 weeks, and you will have forex lecture from next week and following week as well. Thank you.